Okay, you may start now.
Good morning, everyone. We are the third presenter, and today we are going to present about the asset-based approach. So, to start with, next slide, please.
Ma'am, for a minute, I am the first reporter and nagloading ako ang script. Is it okay if we wait for a minute?
Okay, sure. No problem.
Thank you, ma'am.
Joanna Marie, your name is not included no sa list.
Sorry, Miss. What list, Miss?
On the first slide, you have there a list of the members.
Vaughn, can you show the previous slide? Wala, Vaughn.
So, ikaw ra ang wala na appeal din, ha?
Yes, Miss. Yes, I'm
Okay.
included. Miss. Sorry.
Sige, sige. Also, I noticed that based on your PowerPoint presentation, you didn't include the Philippine valuation standards on asset-based approach.
Ma'am, I'm so sorry to keep you hanging for is it okay for a minute sa gyud as in dead gyud ang akong usa ka device.
Okay, so while waiting for Rachel, can we discuss first the valuation standards with respect to asset-based approach? I think it wasn't included in your presentation. So I just need a member to just read the standards.
Okay, Miss. Let me open it, Miss. Sorry.
Vaughn, do you have a copy of the standards so you can present it sa screen?
I don't have a copy right now.
Okay, let me just na lang present it.
I think uh excuse me, hello? Patay. Kuan. I think one of my group mates have. So I think I will stop presenting myself.
Okay, sige.
Hello, Miss. Good morning. So, do I just read the asset based approach standard?
Yes, but I need you to present it as well sa screen so everyone could follow.
Hello, Makita Ra.
Yes, makita.
Is this the one you're referring to, Miss?
Yes.
Okay.
So the asset-based business valuation approach or the standard. So in business valuation, the asset-based approach may be similar to the cost approach used by valuers of different types of asset. The asset-based approach is founded on the principle of substitution, or an asset is worth no more than it would cost to replace all of its constituent parts. In the execution of the asset-based approach, the cost basis balance sheet is replaced with a balance sheet that reports all assets, tangible and intangible, and all liabilities at market value or some other appropriate current value. Taxes may need to be considered. If market or liquidation values apply, cost of sale and other expenses may need to be considered. The asset-based approach should be considered in valuation of controlling interest in business entities that involve one or more of the following: an investment or holding business, such as a property business or a farming business, a business valued on a basis other than as going concern. The asset-based approach should not be the sole valuation approach used in assignments relating to operating business, appraised as going concern unless it is customarily used by sellers and buyers. In such cases, the valuer must support the selection of this approach. If the valuation of an operating business is not on a going concern basis, the assets should be valued on a market value basis or on a basis that assumes a shortened time period for exposure in the market if that is appropriate. All costs related to the sale of the assets or the closing of the business need to be taken into account in this type of valuation. Intangible assets such as goodwill may not have value under these circumstances, although other intangible assets such as patents, trademarks, or brands may retain their value. If the holding business simply holds property and receives investment income from the property, market value should be obtained for each property. If an investment holding business is to be valued, the securities, both quoted and unquoted, the liquidity of the interest, and the size of the interest may be relevant and may lead to a deviation from the quoted price. Reconciliation processes.
Okay,
The
I think
value
that's the last part for the asset-based valuation because the reconciliation process is different. Okay, so based on what Connie has read on the Philippine valuation standards, you can see there that the asset-based approach is quite similar to cost-based approach. But later on in their discussion no, sa kaninga group, you will find out that asset-based valuation is not entirely equal to cost-based approach. And they will also be discussing why, okay? But the methods on asset-based business valuation approach and the cost-based is can you still hear me?
Naputol ka ka-jute slide. Miss. You're not talking as out. Oh, ma'am, we cannot hear you, ma'am.
Sorry, I think I lost my connection. Can you hear me now?
Yes,
Yes,
miss.
miss. Yes, miss.
Okay, so as I have mentioned, asset-based approach is quite similar to cost-based approach. However, they are not entirely the same. The reason will be discussed by your classmates later on. And then you also have to take note that in the asset-based approach, we have to look into the intangible assets. And then there might be times that the some intangible assets will not be recorded, especially goodwill. And the group members here will discuss the reason why sometimes a goodwill is not recorded in the report of the business valuer. And then it was not mentioned in the standards that there are two methods under the asset-based approach, but the group members here will discuss the two methods. Kindly take note of those methods, okay? Sige, you may continue.
Okay, so good morning, everyone. We have already tackled the two of the general accepted business valuation approaches, and we're off to the third one, which is the asset based approach. So, next slide, please. The asset based approach, although less commonly applied in the income and applied than the income and market approaches, it is required by most authoritative business valuation professional standards that are shown on the slide, like the AICPA, SSVS, and USPAP. And such professional business valuation standards require the consideration, but not necessarily the application of this approach. In practice, many analysts immediately reject this approach because of the reasons that it is too difficult, it is too time consuming, too client disruptive, or simply not applicable to the subject held company. Also, the completion of the asset-based approach often requires more analyst time and more data, which means the company will have to um, have more expenses, or it will add up to more cost. For the next slide, the asset-based approach is also called the asset approach. It encompasses a set of methods that value the company by reference to its balance sheet, unlike the income or market approaches that focuses on the income statement and or the statement of cash flows. Um, on one of the very first procedures in any closely held business valuation is to define the business ownership interest subject to valuation. That is, the assignment should specify whether the valuation intended to conclude a defined value for the subject company's first total assets, or to the long-term interest-bearing debt and total equity, total owner's equity, or one particular class of owner's equity. Each one of the mentioned is a valid objective of a business valuation, and each conclusion is referred to as business value. In any event, the asset-based approach rather is based on the principle that the value of the subject company is equal to the value of company's total assets minus the value of the company's total liabilities. So as you can see there in the slide, you have the formula and um, the one that is marked in red. Also, there are two important words in the formula mentioned, and these are the value and the total. And as to why, we'll find it in the next slide. First, the asset-based approach is based on the value of all assets and liabilities of the subject company. The standards of value, which is determined by the assignment, as well as the valuation date of the analysis, should be defined. The common standards of value include fair value, investment value, owner value, use value, and user value. Second, this approach is also based on the total of all the company's assets and liabilities. GAAP-based balance sheet typically exclude major categories of company assets and liabilities like the internally created intangible assets, which represent the major sources of value for any subject business entity. Unlike the GAAP-based balance sheets, the asset-based approach recognizes the current value of all the company's tangible and intangible assets and all the company's record and contingent liabilities. Next slide, please. So since this approach is required to be considered, the relevant analyst question should be, when can I not perform the asset-based approach? Because diba, you mentioned man siya nga, it is required, however, not necessarily nga i-apply siya sa company. So the question should be, when can I not perform the asset-based approach? Therefore, the reasons why this approach should not be performed should be substantive or um, dapat not just because ay dili lang gusto sa company or the company doesn't feel like applying it. So it should be substantive, sorry, and should be described in the business valuation report. So there are four factors that affect the selection of the applicable valuation approach. First, we have the type of subject company. Second, the type of subject business interest, the type of business subject transaction, and lastly, the availability of necessary data. For the first factor, which is the type of subject company, it is usually believed that the asset-based approach is only applicable to so-called asset-intensive companies. Although this is technically correct, it ignores the reality that virtually every company is an asset intensive company. And therefore, this approach applies to most companies since it is applicable to both tangible and intangible intensive companies. In short, it is applicable to companies that owns assets. So basically, we all know that all companies have assets. Okay? I mean, how could they run without even, a building? So second factor, the type of interest may influence the selection because this approach concludes a controlling, marketable ownership interest level of value. Therefore, asset-based approach is particularly applicable to the valuation of an overall business enterprise. Third factor, the valuation approach is applicable to a company merger and acquisition analysis, a stock exchange ratio analysis, a fairness opinion, a solvency opinion, or any other transaction involving the um, overall business enterprise. And for that is structured as an asset purchase transaction. And last factor, if the analyst has no access to company asset specific information, like there's no available information regarding the company's individual tangible or intangible assets, this fact will affect the analyst's ability to use the asset based approach. So as you can notice, all of these have reasons nga that are substantial. So i-disclose na siya sa report if ever dili ma-use ang kanina approach. For the sixth slide, next slide please. So this is where we talk about how asset-based approach and cost approach rather is not the same. The asset-based approach is not the cost approach. One of the very important distinction is that the former is generally is a generally accepted business valuation approach that has an objective of estimating a business equity or total net asset value, while the other is a generally accepted property valuation approach which aims to estimate the value of an individual tangible asset or intangible asset. The asset-based approach is used to conclude whether there is a tangible value in the nature of goodwill, which indicates a positive CEEM, or the capitalized excess earnings method, and second, if there is an economic obsolescence adjustment that needs to be made to the cost approach, which has a negative CEEM. On the other hand, the cost approach can be used to value various categories of company tangible assets, like the machinery and equipment, or intangible assets, like a trained and assembled workforce. And these three are the cost approach methods. First, you have the reproduction cost new less depreciation method. Second, the replacement cost new less depreciation. And third, the trended historical cost less depreciation method. In short, the asset-based approach typically incorporates cost approach property valuation methods to value certain tangible and intangible assets. However, it also incorporates the income approach and the market approach. So, as what I've mentioned, the most distinct approach is that the approach can also be used when you do the asset-based approach. It is just one of the methods, and so the asset-based approach values the business or the business equity and the total net asset value, the business as a whole, and the cost approach just values the individual tangible or intangible asset.
So the asset-based approach does not conclude a liquidation value. Many analysts and clients believe that the application of the asset-based approach concludes a liquidation value and not a going concern value for the subject company. They have incorrectly assumed that any sale of any asset is a liquidation transaction that yields a liquidation value. This analyst belief is simply misplaced. Although it is true that the asset-based approach may conclude a liquidation value for the subject company if all of the individual asset values were concluded on a liquidation premise of value basis. Likewise, it will conclude a going concern value for the subject company if all of the individual tangible asset and intangible asset values were concluded on a going concern premise of value basis. So it totally depends on the premise of whether the company would want to go out of business or still continue on its operations. Next slide, please. Valuation of liabilities in the asset-based approach. Most analysts focus on the valuation of the company assets during the application of any asset-based approach valuation method. However, the valuation of the company liabilities can also be an important procedure in this valuation approach. The first procedure in the liability valuation is to understand the appropriate standard of value objective and the subject assignment purpose. That is, the analyst may conclude for a different value for the same liability if the standard value is fair value versus fair market value versus investment value or versus some other standard of value. Second, as one part of the asset-based approach, the analyst may revalue all of the company's recorded bond, note, mortgage, and debenture liabilities. This, This analysis would include the entirety of the company liability accounts, including any long-term debt amounts that are recorded as a current liability for financial accounting purposes. Third, the analyst may identify and value all of the company's contingent liabilities. Although such contingent liabilities do not meet the GAAP requirements to be recorded in the balance sheet, they may still have a material effect on the value of the company's equity. And one way to value such contingent liabilities is through the NPV analysis, which considers the expected amounts of and the expected timing of the future cash payments. Next slide, please.
Okay, Kyra, why do we need to value again liabilities in performing the asset-based approach? Why do we need to value the liabilities? Why not just assets? Anong appeal man sa liabilities?
Miss, can I answer, Miss?
Oh, okay, Joanna.
Because asset-based approach is it's more on the equity, Miss. So you have to you have to also value the liabilities and deduct it from your assets, Miss.
Correct, correct. So, the asset-based approach is actually misleading in a sense nga, may kag asset-based, murag asset lang kuno hay imong tan-awon, but based on the discussion so far, ang asset-based approach is actually net asset-based approach. But ang term lang niya is asset-based approach, but what we are looking here is net asset. And we already know that net asset is also known as equity, right? Because net asset, when we hear the word net, that means something has already been deducted. And to arrive at net assets, we have to deduct the liabilities from the assets. So assets minus liabilities is equal to net asset. That is why we also have to value the company's liabilities. And as mentioned by Kyra, the contingent liabilities are also taken into account. Remember when you studied your financial accounting with respect to liabilities, diba? A liability to be recognized in the balance sheet, it must be probable and measurable, right? Probable and measurable. But contingent liabilities do not meet the recognition criteria nga, probable and measurable. So, therefore, when we use the GAAP or for financial accounting purposes, contingent liabilities are not recorded in the balance sheet. Thus, when you look at the balance sheet of a company, you will never see the word contingent liabilities kay they are not recognized man in the balance sheet. However, they are disclosed in the notes to financial statements. Diba? Ang requirement nato for contingent liabilities is merely disclosure, dili recognition. So just disclose in the notes to financial statements but not recognized in the balance sheet. However, for business valuation purposes, specifically under the asset-based approach, contingent liabilities are taken into account. So apilon siya og deduct from the assets to arrive at net assets or equity, right? But for GAAP purposes, wala siya ilabot. So that is why also the report that we have to come up under the asset-based approach, the balance sheet that we should come up under this approach is different from the balance sheet that we typically prepare under our financial accounting standards. Okay, so that was mentioned by Kyra. All right, sige, proceed.
So, next slide, please. So, treatment of income taxes in the asset-based approach. In an actual sale transaction, the seller would be responsible for income taxes related to any gain on the sale. And that gain on the sale would be calculated as asset sale price based on the concluded asset value minus the asset tax basis. For many of the intangible assets included in the valuation analysis, it's good to note that the tax basis for such assets is often zero. Next slide, please. Most analysts implement one of three alternative procedures with regard to the treatment of income taxes in the asset-based approach. 1. Ignore all income tax consequences related to the revaluation of the company assets. The reason behind this is that some analysts are not income tax accounting experts. And some also say that the company asset will not actually be sold, so income tax payment will not actually be made. So, two, calculate the expected income tax liability associated with the asset revaluation and recognize that specific liability on the revalued balance sheet. 3. Calculate a deferred income tax liability account based on the present value of the expected future income tax payments. Since there is a divergence of analyst practice regarding the treatment of income taxes in the asset-based approach, this discussion does not actually recommend a right or wrong procedure. However, it's recommended that each analyst make a conscious decision as to which income tax liability convention to implement. Next slide, please. The asset-based approach and the valuation synthesis and conclusion. In valuations performed for transaction, taxation, controversy, or many other purposes, analysts should consider asset-based approach value indications, along with income approach and market approach value indications. Ideally, the asset-based approach value indications will reconcile reasonably well with the other value indications. When there are differences in value indications between approaches, these differences should be explainable. If the asset-based approach value is materially lower than other value indications, that may indicate one or more of the following. 1. The company owns additional intangible assets that were not included in the valuation. 2. One of the intangible assets such as goodwill could be undervalued. 3. One or more of the company liabilities could be overvalued. On the other hand, if the asset-based approach value is materially greater than other value indications, it may indicate one or more of the following. There is unrecognized economic obsolescence that should be considered in both the tangible asset and the intangible asset valuations. 2. One or one or more intangible assets may be overvalued, potentially due to the double counting of the intangible asset value. Third, the values of the company liabilities, particularly contingent liabilities, could be understated. The analyst's additional diligence procedures should be able to identify and correct any of these situations. Next slide, please.
Okay, so from that slide, we can understand that asset-based approach should not be the only approach nga gamiton sa business valuer. Okay, because we need to also compare our amounts that we have come up using the asset-based approach, compare it to the amount that we have arrived using other approaches. Like the very basic approach is the market-based approach. Muna siya ang most widely used na approach. So you should not, as a valuer, for example, you are not expected to just use the asset-based approach. In fact, here you can see no nga, you have to compare it to the other value indicators. Ang kaning value indicators mentioned here are those values that we can come up using the income-based approach and the market-based approach. So imo siyang i-compare no side by side. So if the value that we have come up using the asset-based approach is materially lower as compared to the value that we have come up using the income-based approach and the market-based approach, then these three, kaning tulo ka book nga gilista, these are the possible reasons why the value under the asset-based approach is materially lower. Or if it is materially greater than the other value indications, then you also have the possible reasons. So from this, you can infer that the asset-based approach will actually yield to whatever values that you can come up under in the income-based approach and market-based approach. When I say mo yield siya dito mo siya og mo give way. So dili siya ang controlling. So for example, if there are material differences between the amounts, what would prevail are those amounts under the income-based and the market-based approach. The asset-based approach will yield to mo give way siya sa values nato sa other approaches. Okay? So ang ato ang timan-an diri dili pwede nga asset-based approach lang ang gamiton. Dapat gamiton siya simultaneously with other approaches. Alright, sige, continue.
So there are several generally accepted asset-based approach business valuation methods. The most common methods within this approach are the asset accumulation method and the adjusted net asset value method. And these two approaches will be explained thoroughly by the following reporters.
Uh, Good morning, everyone. Can I be heard?
Yes, Vaughn.
Okay, okay. First, the first method that is discussed would be under the asset-based approach, the asset accumulation method. So what is the asset accumulation method? So it is a business valuation method that determines the business value as the difference between the current value of all business assets and the current value of all its liabilities. Well suited for business, and it is well suited for business and security valuations performed for transaction, taxation, and controversy purposes. So while the asset accumulation method uses the familiar balance sheet format, it uses the fair market value to value the entity's assets and liabilities instead of the book value. And additionally, sometimes other businesses would prefer other kinds of valuation methods that was discussed earlier by Ms. Martin. So basically what we're trying to find under this method is the value of an entity, which is the difference between the value of its assets and liabilities. So the asset accumulation method procedures involves only 3 steps, and it's similar to what was discussed earlier. First, we have to identify all of entities' asset and liability categories. Second, we have to value all of the identified asset and liability accounts. And then, lastly, we subtract the total liability value from the total asset value. This may sound very simple, but it's actually very koti in practice. And it will be explained further. So the step 1 is to identify all of the entity's asset and liability categories. And by all, this includes all of the accounts and categories that were not recorded also in the balance sheet. So all asset and liabilities accounts are subject to revaluation. And analysis starting with an audited balance sheet is preferred, but it is not required, since it's subject naman gihapon to revaluation. So the values will still change. And it is more convenient to start with a balance sheet prepared as close as possible to the assignment valuation date. In cases where there is no entity balance sheet available, the analyst has to start with a blank page and independently identify all of the asset categories and liability categories associated with the subject entity. So in the second, furthermore, when we say all this on the slide are what we're trying to identify. So the assets to identify are those that are already recorded. Second is the owned and operated but are not recorded on the entity's balance sheet. And third is the off-balance sheet intangible assets, or those intangible assets that are internally generated. So next, we have the liabilities to identify. We identify all liabilities already recorded on the entity's balance sheet, and also liabilities that are either not typically recorded on the balance sheet or created as part of the hypothetical sale transaction. So for the second step, we value all of these identified asset and liability accounts. So we have to restate all of the recorded asset and liability accounts to the assignment standard of value. And these standard of value, this was what was discussed by Ms. Martin a while ago, the four values. And when we value all, we also record all of the previously unrecorded assets and liabilities at the assignment standard of value. We also have to consider all of the generally accepted property valuation approaches, such as cost approach, market approach, income approach, and we have to ensure that the individual asset and liability accounts are restated to the same standard of value and to the same premise of value. So the last step is to subtract the total liabilities value from the total asset value. And this value indication can be adjusted to conclude the value of the entity's invested capital or to conclude the value of the one class of the entity's equity. Value conclusion should be stated as a marketable controlling ownership interest level of value.
So, good morning, everyone. So, I'll be tackling about some of, sorry, just a second. So, we will focus for now on the identification and the valuation of an entity's asset and liability accounts. So, before I start, sorry, I have to mute myself sometimes because I'm sick, so I have to like cough. So, I'm sorry about that. Okay, so for different account categories, usually it requires different standard of value, so different valuation methods under the AA. So we always have to be mindful and apply a consistent standard of value. This is in line, of course, with our maybe app or whatever standard that you're following. Next, please. So to start with, we have our current assets. So for our current assets, of course, the analyst should first, of course, confirm if these assets actually exist. And the next step would be they have to restate the asset balances to the current value. So for example, if you have a historical value of your asset, you have to restate it to the current value as of the valuation date. So usually, since these are current, they don't really change materially. So the recorded current asset account balance is representative of the intended standard of value account balance. But if there are material differences in amounts, so you could revalue accounts. Let's say, for example, let's say accounts receivable. So in order to revalue accounts receivable, you might want to set up a contra asset account like allowance for doubtful accounts, or let's say we are going to account for inventory obsolescence. Let's say your inventory or your products will not be sold anymore. So you could use FIFO or maybe a replacement cost estimation for that. So you could use a contra asset as well for those for those changes. Okay, so next one we have the real estate and our tangible personal property. So for our real estate, we know this includes our land improvements, building improvements. For tangible personal property, this would be our machinery, our equipment, let's say office equipment or furnitures. So those are the inclusions. So there may be a material difference between their historical costs on their balance sheet and their current values as of the valuation date. So again, you have to perform, or the analyst may choose to perform asset valuation or just rely on the appraisal performed by third-party specialists. So the analyst has the choice to actually rely on appraisals by third-party specialists. So for its valuations, when we talk about, let's say, land or land improvements, you could use your market approach for this. You could also use the sales comparison method. For the buildings or other building improvements, this is where our replacement costs and replacement cost less normal depreciation method comes. Okay. Also, usually we also have what we call leased TPP. So for leased tangible personal property, we have to investigate whether the entity operates a leased TPP. So usually they are accounted for as operating leases in GAAP. But for AA, usually we consider or we capitalize them. So it means kind of like we record them. Mhm. Next one, we have our intangible real property. So for our intangible real property and intangible personal property. So examples of intangible real property are our real property leases. We have easements and right of ways. Let's say mineral mining and its extraction rights. So for intangible real property, these are usually valued using various cost approach, market approach, or you could also use income approach, property valuations. For our intangible personal property, this could be customer related intangible assets or contract related intangible assets. So there's a number of this. Same thing, you could also use various cost approach, like market approach and income approach as well. Commonly for let's say ITP, or depending on what you have, sometimes you have to use the RCNLD method, so the replacement cost less normal depreciation method. You also have relief from royalty method, also the multi-period excess earnings method or the mean method. So we have to be careful though, not to overvalue our intangible asset. So you can't assign the same value increment to more than one intangible asset, and um, you can't let any value increment fall through the crack. Okay, so next one we have our intangible value in nature of goodwill. So we're talking about goodwill now. So this category includes the entity's goodwill and going concern value. So the capitalized excess earning method is used for this, the SEAM. So it's used to estimate the value of goodwill. And the SEAM method relies on three values already given, which is the value of our current asset, the value of our real estate and TPP, the value also of our RIP and IPP, so intangible real property and intangible personal property. So in order to value it, so the steps include you have to assign a fair rate of return to all identifiable assets. So in to do this, for example, you have to total all your identifiable assets and assign a return to them. By doing this, you could actually get your required earnings, and you just have to compare your actual earnings against your required earnings. So our interpretation would include if our actual earnings is more than our required earnings, that's when we have positive goodwill. However, if it's the other way around, if our required earnings is higher, that means we have the negative goodwill or the economic obsolescence. Okay, next slide, please. Vaughn. Oh, sorry. Okay, I got it. Right. So we have our other assets. So for other assets, we could categorize them either as non-current financial assets, like our investment in our subsidiaries and all, or we could also have them as excess or non-operating assets. So these are our assets that are let's say, held for investment purposes, or the assets that are held for sale. So the typical valuation for this asset is usually based on the NRV, so the net realizable value, which is the expected selling price less our cost of disposal. Next is our current liabilities. So for current liabilities, again, it's current. So usually it's due in less than a year. That's why there's actually like very little valuation or revaluation that you have to do with our current liability accounts. But for some companies, it says that sometimes they would mix their current liability with their long-term liabilities, and that's when analysts would have to revalue. So for our long-term liabilities, these includes these are readily identifiable already because usually you can find them in your balance sheet. So usually they are restated to the amount which they are to be extinguished as of the valuation date. Mhm. But there are factors to consider when you are revaluing your long-term liability. So it includes your embedded interest, your current interest, your term to maturity, your payment history, and all. Okay, and next one is we have our contingent liabilities. So again, these are liabilities that you can't really find in your balance sheet because they're not, or you still have to identify if you have them. So examples of this would be, let's say, litigation claims or contract disputes, taxation audits, and other reviews. So in order to check if you have contingent liabilities. So the steps would include first, you really have to identify if the liability exists, and you have to estimate a value for the liability. So you can estimate the value by using this methods. What do you call that? Noted here, we have the scenario analysis or the decision tree analysis. And the values you have to estimate would include the amount of liability payment, the timing of the payment, and the probability of the payment. So those are mostly our accounts and valuations under the AA. Next, please. Next slide, please. Okay, thank you. Right. So here now we have our conclusion. So as I said earlier, for the asset accumulation, it's mainly concerned with the equity, so with the net asset value. So that's why that as soon as you already have the total value for your total asset and your total liabilities, you could already derive your equity here. So this is actually the mathematical procedure of the AA. So um, but of course it also includes your marketable controlling interest. So sometimes you have to discount your values in order to account for, let's say, the lack of control. So if your ownership interest isn't 100%, that's why you have to discount for control, and you also have to discount for the lack of marketability. So this presumes that other entity level valuation has been considered, such as adjustment for key person independence, key customer independence, and key supplier independence. So that be all. Thank you.
So good morning, everyone. Today will be me, Miss Komaling, and Mr. Ortiz will be um, doing the report on the adjusted net asset value method, the second and the last asset-based valuation method that we will be discussing today. And before we get started, I advise everyone to open the handout provided by Ma'am Hamizola and Canvas, specifically the third one, because we will be consistently referencing the methodology, especially in the illustration portion. So next slide, please. So what is the adjusted net asset value method? It is an asset valuation method that changes the stated values of a company's assets and liabilities to reflect its estimated current fair values better. So it is a valuation method that primarily focuses on identifying if the entity is being valued above or below its required rate of earnings. And lastly, It is a method that bases its valuations directly from the financial information of the entity's firm, specifically the balance sheet as provided by Ms. Martin a while ago. So as what Ms. Amisolo said a while ago said, the asset based approach is somewhat misleading because it would lead you to believe that it is primarily focused on the revaluation or the revaluation of assets, but basically it is um, focused on revaluing the company's what is the actual amount or what is the actual value of the equity of the entity, and it is more appropriately described with the name the adjusted net asset value method. As provided in the guidance note, net asset is basically equity, total assets less total liabilities. So next slide, please. So what is the differences or what are also the similarities between the adjusted net asset value method or the ANAV method and what was described earlier versus the asset accumulation method? So the adjusted net asset value method is quite simpler as opposed to the asset accumulation method. Based on the handouts provided, it is stated that the asset accumulation method is mainly used and is appropriate for transactions, taxation, litigation, and controversy purposes. It identifies and then analyzes the roles of different assets and asset categories in asset bundles, no, in order to estimate its values. Whereas in our report, you will understand that the adjusted net asset value method is used preferably to conclude um, entities marketable controlling ownership interest level of value, or simply put, what is the estimated fair value of the equity. This will make more sense in the illustration. No? It is quite simple, actually. So both methods, if applied consistently and with the use of consistent valuation variables, will provide similar results. And both asset valuation approach methods can provide or can conclude the following: total business enterprise, total business assets, total business owner's equity, single class of owner's equity, and a specific block of owner's equity. Next slide, please. Okay. So what is differences with net book value? Because there may be some kalang misunderstanding because primarily because the information based off the adjusted net asset value is taken from the balance sheet. So the net book value method or the net book value is not an accepted business valuation method. It is limited and mainly concerned about the data coming from financial statements. Keyword ha, without any regard to valuation analysis or judgment from a professional analyst. So as explained earlier, there may be some instances that certain assets and certain liabilities will not be reported in the balance sheet because it is compliant with GAAP provisions and kalang GAAP based and is typically recorded on a historical cost basis. Where but then the adjusted net asset value method can also use the net book value of an entity as a basis or starting point of its valuation. Remember, balance sheet. And an analyst will then conduct a series of valuation procedures and with professional judgment can provide a current valuation and the estimate of the owner's equity. So the keyword and the only thing to remember about the adjusted net asset value method is equity, and to calculate the estimated actual, if that makes sense, of the entities owner's equity. Next slide, please. So now will be me and Mr. Ortiz will be discussing the methodology used in the adjusted net asset value method. Next slide, please. So the first step of the adjusted net asset value method is to obtain financial information. So the analyst begins with the subject company's balance sheet, preferably one that was prepared before the analysis valuation date or what is the most recent balance sheet, and rightfully so, no? Unlike the market and the income approach, wherein they base their valuations from the cash flow statement and the income statement. The asset-based approach, regardless of any method, bases its valuation from the balance sheet. This might also be the reason why in the handouts they particularly make the distinction between net book value balance sheet and asset approach balance sheet because of this characteristic. No. Next slide, please. Step 2 is to identify and separate operating items from non-operating items. So non-operating items and excess assets will be separately analyzed. Such assets may include vacant land, assets held for investments, private aircraft, private property owned by the company, and tangible assets discontinued by the company which is held for disposal. Although it is not limited to the following items just mentioned, any assets that are not necessary for the business operations are all separated for another valuation. Next slide, please. The third step, this is very important, guys. Remember this because this will be useful in the illustration. So list all the amounts of the following: working capital assets, tangible assets, intangible assets, other assets. This is very essential because the sum of the following make up the net operating assets. Number one, working cap is equal to current assets less current liabilities. Remember this. This is gonna be useful said in the illustration. Number two, total tangible assets including land, buildings, and equipment, PPE. Next, intangible assets. So the key word here in number three is that it is kuan for a while. The key thing to remember it is identifiable intangible assets. Remember that the ANAV method particularly aims to identify the entity if the entity has excess earnings, which will form part in intangible assets in the form of goodwill. And as defined in the guidance note provided, goodwill is future economic benefit from an asset that isn't individually identifiable and separately recognized. So the intangible assets mentioned here, goodwill is not yet part. It is still to be calculated, which will be done using the CEEM or the capitalized excess earnings method. And lastly, other assets such as deferred income taxes and unconsolidated investments. So the next three following steps will be explained by Mr. Ortiz. Thank you.
Um, Good morning. For step number 4, the revaluation of the entity's total net assets. The most common valuation method that is used to perform this single collective revaluation of the net operating assets is the capitalized excess earnings method, or SEM. The SEM is basically a way of calculating if the entity is earning either above or below its required earnings, the excess of which represents the intangible value of an entity in the form of goodwill. So in step 4, we are now revaluating the entity's total net assets. We are going to accomplish this through the use of capitalized excess earnings method. This method can also be used, as discussed earlier, in the asset accumulation method. However, the residual amount of goodwill that is concluded in an asset accumulation method analysis may not represent the same goodwill calculation that could be indicated by the ANAV method. This could be because in the asset accumulation method, it involves the individual revaluation of all assets and liabilities, comparing to the ANAV method wherein there's only a possibility nga the analyst may able to revalue some of the assets or liabilities of the company. Then next slide, please. Step 5, add net operating assets with the goodwill calculated from the same formula to get total net assets. So in step 5, we are going to add net operating assets to goodwill balance calculated from the same analysis. We get net operating assets from the summation of working capital assets, tangible assets, intangible assets, and other assets. Again, those categories were already listed during step number 3 kung i-discuss ni Gerard pag step number 3 i-sum to in order to get the net operating assets. And then for the goodwill balance calculated from the same analysis, we get it through the goodwill na ato ang get from the same analysis, which will be further illustrated the following slides. And the next slide, add the value of any excess or non-operating assets to operating assets to get the total business value. So in step 6, we are going to add excess or non-operating assets to net operating assets. So we get the excess or net or non-operating assets from the amount that was identified or separated from the balance sheet during step 2. Diba earlier, Gerard identified and separated some items from the balance sheet, which are the excess and non-operating assets. And those were further analyzed, like specific, and then i-take out ng tong amount, mo na ang excess or non-operating assets. And then we get the net operating assets from the amount that we got during the step number 5. Then this summation, the total of these two, represents the total business value. Next slide.
So before we proceed to the illustrations, we're going to discuss about the strengths and weaknesses of the ANAV method. So for the strengths, first is that it is quick and easy because it only needs historical financial information to perform analysis like the market or income approach. So as what Mr. Huntilia said earlier, that the ANAV method utilizes the financial information that are already readily available. Number 2 is that it does not require performance of numerous tangible or intangible valuations, because in other methods like the accumulation method, it's most likely categorical. You have to analyze it by category per tangible or intangible. Third is that it does not need third party specialists performing tangible and intangible valuations. So for the weaknesses, one of the weaknesses of the ANAV method is that it cannot be used to estimate the value of a particular asset and does not effectively distinguish tangible and intangible asset value. So since this is not a categorical method, distinguishing the particular value of assets is um is it's not possible to distinguish the particular value of the assets per category. So second is that it may be deceptively simple, and third is that it does not identify source of the business value. Next slide, please. Next slide, please. Um, next, next is that for the strengths, previous slide. Okay, for the strengths, number 4 is that it is much easier to understand for the users of information since it is a simple method. And then number 5 is that it's intuitively obvious. If income is greater than the net book value, then the greater business value, then the then it has greater business value. And number 6 is that it does not disrupt company business operations, and it is used to identify whether or not the company is earning a fair return. For the weakness, it does not identify asset spin-off opportunities, undervalued assets, refinancing opportunity, and refinancing opportunities, since this method estimates the assets as a whole, not by category. Number 5 is that there are application limitations with regards to comparing business values, and analysts should be aware of the importance of each individual valuation variable. Next slide, please. So specific issues in the ANAV method. So these are mostly technical issues that analysts should focus or consider on in the application of this method, and that relates to the professional judgment of the analyst. So issue number 1 is that there are other versions of the ANAV method that the analyst should consider, like the simplest version wherein assets and liabilities are restated at its historical cost. Next is that careful selection of valuation variables and any value appreciation for intangible assets should reduce the value in the CEM analysis. Issue number 2 is that analysts should decide the level of income to be included in the CEM analysis, which will be illustrated further. However, the analyst should select both a rate of return and a capitalization rate that are consistent with the level of income selected to measure actual and required earnings level. Next. Issue number 3, analysts would have to decide on the expected future growth rate related to any excess earnings, because if earnings aren't expected to increase or decrease over time, then the capitalization rate is equal to the weighted average cost of capital. If earnings is expected to increase at a positive growth G, then capitalization rate is equal to the weighted average cost of capital minus the growth rate, and vice versa. So conclusion, the most important key factor here for the ANAV method is consistency, because it is the because analysts should consider that because analysts should consider all the valuation variables within the analyst the all the valuation variables within the analysis should be consistent. Next slide, please. So handling negative goodwill. So there are cases wherein the required earnings is greater than the actual earnings. So negative goodwill should not be reported in the balance sheet prepared in compliance with the generally accepted accounting principles. It is not reported in the company's valuation-based balance sheet prepared and should be eliminated through reducing the concluded value of the previously valued tangible and intangible assets. So negative goodwill is an indication of economic obsolescence. So, what is economic obsolescence? So, it occurs when an operating company does not earn a fair rate of return on the indicated value of its tangible assets and intangible assets. The existence and measurement of economic obsolescence indicates that all of the subject assets that were valued by reference to a cost approach method should be decreased in value. To reduce economic obsolescence, we should decrease the value of all the cost approach measured assets, both tangible and intangible. Next slide, please.
Okay, Connie. So let's go back to negative goodwill. So you mentioned that negative goodwill should not be reported, right? But
Yes, ma'am.
but the question is, should we still consider it in revaluing the other assets sa company? So although the negative goodwill is not recorded, should we entirely ignore it? Kaya di man din i-record, ignore na lang ni or not?
Um, negative goodwill should negative goodwill should not be ignored, but rather it would be
Mhm.
the resulting cost approach conclusion should be reduced to equal to a goodwill of 0 and the remaining economic obsolescence of 0, ma'am.
Correct. So then, although the negative goodwill is not reported, ang pasabutan ng not reported, if you look at the balance sheet, wala kay makita dira nga word nga negative goodwill, but rather it will be incorporated in the form of, like, you will record an impairment of specific assets. So kay negative goodwill man siya, as mentioned by Connie, this is indicative of economic obsolescence, no? So there are obsolete items, or there are impairment of some assets. So therefore, the value of the negative goodwill will be used as a basis for the reduction or decrease, i-minus siya sa mga assets nga na-impair na. So, in a sense, we will not ignore negative goodwill, but rather, we will use the amount of negative goodwill to record the impairment of specific assets. However, the specific word nga negative goodwill will not be reported in the balance sheet. And again, we have a negative goodwill if the required earnings are greater than the actual earnings. If the opposite is true, if the actual earnings are greater than required earnings, what do we have, Connie?
We have a goodwill, ma'am.
We have a positive goodwill, right?
Goodwill.
So if the opposite is true, kaning actual earnings is greater than required earnings, we have a positive goodwill. And then if we have a positive goodwill, do we report it in the balance sheet?
Yes.
Yes, okay, correct. So let's continue.
Uh, so today we'll be having the illustrations for the adjusted net asset value method. So next slide, please. So first we'll be discussing the no individual asset revaluation. So remember that the adjusted net asset value method bases its valuations of the balance sheet. So this is the balance sheet of the entity. And if you are already open, if you have already opened the handout given in Canvas, um, the following data is already given. Next period normalized earnings, 9 million, fair rate of return 15%, expected long-term growth rate 0%. As to how you get the fair rate of return, it actually involves a very complicated process and was not given in the handout. This is most probably the reason why it was given in the first place. No, so also in the name in itself, it mentions no individual asset revaluation. So, as the name implies, there may be instances that certain individual assets are revalued and may change the results when conducting the capitalized excess earnings method. But nonetheless, the process remains the same. No. So, how do you conduct the capitalized excess earnings method? No. So, next slide. So it's actually very simple. So what you just have to remember is um, as provided in the methodology, specifically in the step 4, you have to multiply your net operating assets with the required rate of return. And as provided earlier, the required rate of return is 15%. Yeah. Provided in the balance sheet, it only specified its working capital, which is 4,000, or 4,000 because current assets less current liabilities, no? So 10,000 minus 6,000 in the balance sheet on the previous slide. Yeah, next is PPE, which is in total 40,000. This PPE is net of depreciation or any impairment. Huh? So you add both of those amounts, and you, in order to get excess earnings, you just have to deduct normalized earnings, or yeah, normalized earnings or actual earnings with the total required earnings, then you get excess earnings. But this 2.4 million excess earnings isn't the intangible assets in the form of goodwill. There is still a formula that you need to do down below, capitalized excess earnings analysis, wherein you have to divide it with 15%. There you get 16 million. But remember in the previous slides had it made mention there was. Can you go to the previous slide? It mentioned it has 0% expected long-term growth rate. Why is this very essential? So in the formula, next slide na po, please. Thank you. In the formula, it is excess earnings divided by appraisal rate or discount rate minus expected long-term growth rate. So since 0 months siya, dito na 15%, there you get 16 million. So um, remember, remember the balance sheet is GAAP based and does not report specific assets and specific liabilities. Especially in the asset portion, it does not report goodwill. So now in the next slide, we will show you what the ANAV balance sheet looks like. No, so simply like once you get the intangible assets in the nature of goodwill, you just place that here in the asset portion. Yeah, since the primary purpose manjud of the adjusted net asset value method is to revalue or to know to make an estimate of what is the actual value of total owner's equity. You add Resia, you add that amount with total owner's equity, which is 20,000 before. Now na it is 36,000, added with the 16,000 of intangible value in the nature of goodwill. And to add, before we segue into following illustrations, no, as mentioned that negative goodwill is not reported, and it will make more sense no once we present like the balance sheet where it presents what happens if the entity experiences negative goodwill. How do you conduct the CEM method, like and where do you allocate where do you allocate negative goodwill? To which asset or asset groups do you allocate negative goodwill? Which will be explained both by Mr. Ortiz. Thank you.
For the next illustration, it is about the intangible asset valuation. Next slide, please. Next slide. So here, same regapon, let's assume that the company hired an analyst to estimate the value of 100% of their equity. So the given information are still the same RAM balance sheet. For the current assets, remember nga nato, for current assets, 10,000. For the property, plant, and equipment, net 40,000. For current liabilities, 6,000. And then the owner's equity, 20,000. And then the next, same regapon ang next period normalized earnings, which is 9 million. The same fair rate of return, 15%. And the same expected long-term growth rate, 0%. The only difference between the previous illustration and this one is that the analyst is able to revalue certain of the assets that are already recorded on the balance sheet. Okay, the previous illustration, kay there are no revaluations of individual assets. The analyst only based his amounts from the recorded balance sheet. While here, the analyst is able to revalue some of the assets basing on certain valuation methods. So those assets that are being revalued are inventory, which is 6,000 using the market approach, land 12,000 using the market approach, building 14,000 using the cost approach, and equipment 24,000 using the market approach. So next slide. Since we have all of the given information, let's proceed to the CEM analysis. Sama ni siya. So ang CEM analysis, nano siya to look apart, to look a row. First is ang balances. So let's do it individually. First, for the working capital assets, how do we get working capital assets? We deduct the current liabilities from the current assets. So unsa man tong current assets, 10,000, and then current liabilities is 6,000. So 10,000 minus 6,000 is 4,000. When you're not dire kay what is imputed here is 5,000. So nganong different man? Because nanay revaluation ang analyst, which is the inventory. Instead of 5,000, it is revalued to 6,000. So the total current assets is now 11,000. So 11,000 minus 6,000 is 5,000. And then for property, plant, and equipment, since since the accounts under the property, plant, equipment, which are the equipment, land, and building are all revalued, then the total property, plant, and equipment amount is going to change. Di ba 40,000 man to? Now it's na 50,000. We got that from adding 12 million, 12,000 plus 14,000 and 24,000. After that, we're going to multiply it by the fair rate of return. Since all assets, intangible and tangible assets has the same fair rate of return, which is 15%. So you multiply that to total 5,000 for first working capital assets, 5,000 times 15%, we got 750. And then next for property, plant, and equipment, we got 50,000 plus 15%, we have 7,500, a total of 8,250. So the required earnings. So the required earnings is the item that we are looking for in the first row of CAM. Next row, the excess earnings analysis. So the next period normalized earnings, given man to na, which is 9,000, i-deduct ang required earnings which we got from the first row, which is 8,250. And then the answer is positive 750, so it is an excess earnings. And the next, we're going to compute for the the third row, capitalized excess earnings analysis. We have the excess earnings from the second row, 750 divided by the 50%, the fair rate of return. We got the capitalized excess earnings, 5,000, or the intangible value in the nature of goodwill. So, same magyapon sa first illustration, ato ara siyang i-copy sa balance sheet and then total in order to get the total net out, the total operating assets. Next slide, please. So here, during a balance sheet, kay gipang change na ang value to those properties that were valued, such as the inventory, it's already 6,000. For the property, plant, equipment, the land, buildings, and equipment having 12,000, 14,000, and 24,000 amounts respectively. And then nag-include na tag other line item, which is the intangible value in the nature of goodwill, which we got from the CEEM analysis. And then in order to get the total owner's equity, gi-add ang total assets minus all total total liabilities, then we get 36,000 total owner's equity.
Okay, so also take into account, take note na the depreciation is already not found in the balance sheet. Why? Because the revalued amounts, katong gihatag nga revalued amounts for land, buildings, and equipment are assumed to be net of depreciation, net of the applicable depreciation. So that is why you don't need to copy the balance of the accumulated depreciation in your ANAV balance sheet. Okay?
So proceed to next slide. Negative goodwill. Next, please. So for negative goodwill, explain ko balik. So negative goodwill occurs when the actual or normalized earnings fall below the total required amount of earnings. So if ang actual or normalized earnings is lesser than the required amount earnings, there will be negative goodwill. Then this could also signify that the entity is experiencing economic obsolescence. And then negative goodwill is not reported in both GAAP and ANAV method balance sheet, as stated before. And then it is often allocated or eliminated towards individual assets recorded using the cost approach. So let's proceed to the illustration. Next slide, please. So here, same ra gyapon, nag-hire gyapon ang company of analysts in order to estimate the 100% of the total owner's equity. Same balance sheet, same next period normalized earning 9 million, per rate of return 15%, expected long-term growth rate 0%. But now, ang na-change is the equipment. Same ra ang katong revaluation, revaluation gyapon, 6,000 for inventory using market approach, land 12,000 using market approach, building 14,000 using cost approach, and ang na-change is the equipment valuing to 30,000 using the cost approach. Next slide, please. So for the SEAM analysis, sa first row, same ra gyapon, working capital assets, gi-minus ang liabilities from the current assets. We got 5,000. For property, plant, and equipment, gi-total ang 12,000 for land, 14,000 for building, and 30,000 for equipment, a total of 56,000. And then we multiply each to the fair rate of return. For working capital assets, 5,000 times 15%, we got 750. For property, plant, and equipment, we got 56,000 times 15%, we got 8,400, a total of required earnings of 9,150. Next, second row, the excess earnings or income shortfall analysis. For the next period normalized earnings, as stated, it is 9,000. Then we deduct the required earnings we got from the first row, which is 9,150. We got a deficit or income shortfall of 150. And then sa third row, which is the capitalized excess earnings or income shortfall analysis, katong amount nga nakuha nato sa second row, which is negative 150, i-divide by the direct capitalization rate, which is the 15%. Then we got the negative 1,000 capitalized income shortfall or the economic obsolescence. So the question is, are we going to directly deduct this amount from the asset in the balance sheet? Ato bang para sa earlier illustration nga ato rang magbutang taglaing line item nga negative goodwill and then i-deduct sa total assets? No. What will happen is that the analyst will have to reflect the economic obsolescence by recognizing a proportional value decrease in all tangible and intangible assets that were valued by the application of the cost approach. So ang economic obsolescence is going to be proportionally deducted from those katong na-revalue nga assets. Unsa man tong mga na-revalue? The land, buildings, and equipment. And then unsa ang gigamit nga approach nga valuation significant ang unsang gamit nga approach niya ma-deduct ra siya by through the use of the application of the cost approach. The analyst will have to reflect the economic obsolescence by recognizing a proportional value decrease in all tangible and intangible assets that were valued by the application of the cost approach. First, we will identify those assets valued using cost approach. Those are, next slide please. Those are the buildings and equipment. Diba? Ang building and equipment the use of the valuation method is cost approach. So sila ang magtunga sa economic obsolescence. Now, then after nakuha na nato nakuha na ang 14,000 and 30,000, i-total dayon ang all assets nga gi-valued through cost approach, which is 44,000. And then i-input ang economic obsolescence, which is 1,000. Now, we are going to get the percentage for economic obsolescence, which is 1,000 divided by 44,000. Then we got the percentage, 2.3 percentage. Muna economic obsolescence percentage. Then after that, i-multiply na siya sa cost sa assets, which is for building, 14,000 times 2.3%, we got 300. And then for equipment, 30,000 times 2.3, we got 700. And then after that, what we will do is to deduct it from the cost of each asset in order to get the percentage of economic obsolescence of each asset. So 14,000 minus 300 is 13,700. And then for equipment, 30,000 minus 700, we got 29,300, a total of 43,000. So what will happen is that in the next slide please. What will happen is that there are no recognition of negative goodwill, but only the deductions of those assets valued through the cost approach. So here, makita nato nga buildings is now 13,700, and then for equipment, we got 29,300 rather than katong 14,000 or 30,000. So again, in order to get the total owner's equity, we got the total assets, 66,000, minus the total liability is 30,000. We got the total owner's equity of 36,000. Then, next slide. So for summary and conclusions, the asset-based approach is a generally accepted business valuation approach, and both methods, the asset accumulation method and the adjusted net asset value method, are generally accepted asset-based approach business valuation methods. The AA method requires the discrete revaluation of all of the company's assets and all of the company's liabilities. The ANAV method typically involves the aggregate revaluation of all of the company's tangible and intangible assets. So sa AA method, discussed earlier, it involves individual revaluation of the all assets and liabilities, while in ANAV method, it involves only the aggregate revaluation of all the assets and liabilities of the company. And then the ANAV method is an effective asset-based approach method when either time, budget, or data constraints limit the analyst's ability to perform the AA method. Next. That is all for our reporting, ma'am. Thank you.
Thank you so much. So let's summarize everything. Okay. So for business valuation, we have three approaches. We have market-based approach, income-based approach, and asset-based approach. Now let's recall the methods under the market approach first. So market-based approach, remember, we studied market-based approach in relation to asset side and equity side, right? And market-based approach, we actually encountered multiples, katong mga multiples. So for the asset side valuation approach under market-based approach, we have the multiples, like for example, we have EV over sales, EV over EBIT, EV over EBITDA, EV over free cash flows, right? The numerator is the enterprise value. While for the equity side valuation under the market-based approach, we have the price of your equity. So price over earnings, then we also have price earnings over growth ratio or PEG ratio, What else? We have price over book value, and we have price over free cash flows to equity. And then the specific methods under the market-based approach, we have the comparable companies and the comparable transactions method. Now, for the income-based approach, we have the discounted cash flow method, right? There, we computed the present value of the cash flows. And we also had the asset side valuation and the equity side valuation. And then the main difference between the two is that under asset side, the numerator is free cash flows, while the denominator uses the discount rate of WACC. Remember the WACC? But for the equity side, the numerator will be free cash flows to equity, meaning this is already levered. When we say levered, that means all the debts of the company have already been deducted from the equation. And then the denominator for the equity side is your CAPM. CAPM, okay? So remember the formula in computing for CAPM and the WACC. And then the last approach for business valuation is your asset-based approach. So under the asset-based approach, we have two methods, and those are your asset accumulation method and then your ANAV, or adjusted net asset value method. So what is the main difference between the AA and the ANAV? For AA, as mentioned, I think that was Joanna, no, who discussed AA. So for AA, yes, for AA, we have to revalue all assets and all liabilities. And we also have to take into account those assets and liabilities that are not yet recorded in the balance sheet, right? So you have to discover unsa pa kaha nga mga assets, unsa pa kaha nga mga liabilities ang wala na record dinhi sa balance sheet, and then you also have to revalue them one by one. So lisod siya no kay you have to do it individually. So individual assets, individual liabilities, and then as mentioned by Joanna, the last procedure will be to deduct all the revalued liabilities from the revalued assets. So it's quite tedious. But for ANAV, I think it was Kyra do. Kyra ba? Ikaw ba to Kyra ang nag-differentiate sa AA and ANAV? So for ANAV, was it you, Kyra?
No, miss. It was Gerard, I think, miss. Mr. Montilla.
Okay, so for ANAV, it's quite simple as compared to AA, because again, for AA, no, you have to revalue everything, revalue all assets, revalue all liabilities. But for ANAV, what you will do is you have to start, si Gerard, no? So we have to use balance sheet as our starting point. So whatever accounts are reflected in the balance sheet, kato lang sa ato ang gamiton. Unlike for AA, that we need to discover what else, unsa pa man nga assets o liabilities ang wala pa na record sa balance sheet, and we have to also include them. But for ANAV, we have to use the accounts under the balance sheet as our starting point. And then after which, we don't need to revalue everything. What we will revalue is the aggregate classification lang. If the valuer finds it proper, because diba, their first illustration was that walay revaluation, correct? So the first illustration for ANAV, walay revaluation. There is no revaluation as to any specific asset. What they did was merely to compute the intangible asset, which is goodwill, using the CEEM method. So if you are the valuer using ANAV, there is no need for you to revalue all assets and all liabilities. So that's why it's quite simple. You can actually just proceed in computing your goodwill using your fair return and your normalized earnings, right? And if you have a growth rate, then you have to also take it into account. But the point is, if you use ANAV, there is no need for you to revalue all assets and all liabilities as compared to AA. Now, if you find it proper to revalue some of the tangible assets there, like for example your PPE and your inventory, then you can do so using either the market approach or whatever approach that you deem it proper. Then after which you can compute your goodwill, the same procedure using your CEM method. And then of course if you were able to get a negative goodwill, you know how to allocate the negative goodwill, no, to the assets that are using the cost-based valuation. But regardless of whether you find it proper to revalue some assets sa ato ang balance sheet, the main point is for AA, you have no choice but to really revalue everything. You have to revalue all assets. And when I say all assets, dili ra siya by category. I mean, dili ra siya by aggregate. So for example, if you are to revalue inventory, you have to revalue the inventories on a per inventory basis. If you have lots of inventories, you have to revalue them individually. But for ANAV, like what was illustrated by Levi, there are some items there that were revalued, such as your land, buildings, inventory, and then your equipment. The revaluation was done on an aggregate basis. When we say aggregate, tanan land, regardless of the nature of such land, tanan land gi-revalue. Okay? As a whole. Then, tanan buildings gi-revalue as a whole. Dili ingon nga si building A, building B, building C, tagsa-tagsa og gi-revalue. No, we've done the revaluation on an aggregate basis. So that is why we can say that ANAV method is quite simple as compared to your AA method. But regardless dapat of your method chosen, whether you chose AA or ANAV, dapat you should be able to come up with the same value of your net assets. Okay? So if sigurista ka nga valuer, you can do both methods, and then you have to make sure that the amounts for the business value no kanang imuhang net assets jud nga amount, ang imuhang bottom line, bottom figure must be the same regardless of which method you're going to use. But of course, kay one of the limitations man diba of your asset approach is that it is time consuming. It will require more resources from the company because since time consuming man siya, you have to pay the valuer more hours kay kailangan man siya daghan og oras igahin para ani. So if per hour ang ihang billing sa inyo mas dako inyong gasto. So you might want to just use the ANAV method para mas dali siya ma-accomplish as compared to asset accumulation method. Okay, so just remember all methods that are discussed under each approach. Remember the 3 approaches. Remember the methods that we have discussed under each approach. Okay, so now that we have already discussed the 3 approaches for business valuation, I think you are already ready to take your exam, first major exam. But do you need a study day?
Yes po, we need po.
Okay, so let's look at our calendars.